Hi, I'm Lynn Wise, and with me today is Mark Fleming-Williams. We're going to be talking about the prospect of a cashless society. So, Mark, the EU is investigating whether to decommission the 500 euro note. And this is going to have big ramifications, it sounds like, in the monetary policy. Can you just give us a little bit of background?
Absolutely. So this 500 euro note move is coming from various directions, but basically it's been framed as being all about crime. There was a recent paper which was circulated from Harvard Business School about how high denomination notes essentially are very useful for criminal gangs. They allow them to move money across borders very easily. And so it wasn't just talking about the euro, the 500 euro note, it was talking about the 1,000 Swiss franc note, the 10,000 yen note as well, saying that actually that the global authorities should be trying to phase these things out over time. But it's also not new. It hasn't just come from this paper. It was the 500 euro note was something which was outlawed by the UK back in 2010 as being something similarly which was used by criminal gangs. And also, another thing which could be pushing this at the moment is the Paris attacks and the French focus on trying to stop, particularly Islamic State money moving freely around Europe and being able to finance operations in that way.
But you've just written this analysis that talks about how this is really just another step towards a cashless, completely cashless society. So are there factors pushing against this? Because it seems like we are using our mobile phones more and technology more to make our payments.
There are. There are factors used against it, pushing against it in different ways in different countries. So as you say, there's a general drive, and the technology is a major driver which is pushing this towards. 50 years ago there weren't mobile phones, so you couldn't pay for your restaurant bill by just tapping into your app. There's various technological moves which are driving towards it. And there are some countries which are being particularly progressive towards it, which have focused on trying to move towards the cashless society. Specifically in Scandinavia, Sweden and Denmark are the outliers in terms of embracing this. Denmark's been set a specific target to try and be a cashless society by 2020. But on the other side as well, there are hindrances to it as well. There are outliers against, and that includes countries like Germany. And Germany actually is one of the countries where the idea of eliminating the 500 euro note has caused a bit of a storm in the German press. And the reason is because some of these countries, Japan is another one, they often have monetary trauma in their history. The world wars, particularly World War II in Japan's case, ended up breaking down a lot of the institutions, and they saw hyperinflation happening afterwards. And it created this kind of national attitude towards holding wealth within your house and keeping it safe, and perhaps a mistrust of governments and a mistrust of institutions. So we've ended up in some of these societies with much higher cash usage than in places like Sweden and Denmark, which have had a longer, smoother ride. So there is cultural negativity towards this and cultural resistance towards it. But as I say in the piece, there are technological aspects, but there are also various structural reasons why we seem to be moving towards phasing cash out over time.
So you mentioned Japan, and we also recently talked about Japan lowering interest rates below zero, which was unprecedented. How is that going to affect this? Because if you are paying for cash to be in a bank and that's expensive, how is that going to affect this transition to technology, basically?
Absolutely. Negative rates is completely one of these factors which I was talking about. So we're in a strange time in monetary policy and global monetary policy at the moment because through most of history, 0% interest rates has been seen as far as low as you can go, and it's never really been tested. We've never really tried to go down to 0%. So the theoretical has never really been challenged. The reason for that is the danger is if you actually take your interest rates into the negative, then the central bank starts charging the banks to leave money with it overnight. If the banks then pass that on to customers, the danger is that the customers are going to withdraw the money because it makes more sense to just keep it at home in a mattress rather than leaving it with the banks. And the danger is the money all leaves the banking system, and so eventually, essentially, the government loses control of it, and the central bank loses control of the system. So that's always been the danger and the reason why there's been a kind of lower limit. And as you say, Japan has now moved into negative interest rates. Various European countries already have. Sweden is one. So again, it links into the bigger picture in that way. What this does is, if we do ultimately get to a cashless society, and as every step goes towards the cashless society, it makes it harder to store money in physical form. And so that raises the threshold into negative rates that a central bank can go if they need to do so for their monetary policy. So that's a structural factor which central banks are having to begin to use and to think about, which plays into the governmental desire to perhaps phase out the physical notes.
Thank you. For more on Europe and the economy, please visit stratfor.com.